Stop scrolling. I mean it. Whatever you're doing right now, stop. Because what I'm about to show you is going to change everything you thought you knew about the silver market. Goldman Sachs just made a move that they cannot take back. And I have the internal memo that proves it. 15 pages, dated just 3 days ago. And it contains a number that is going to make your jaw hit the floor. That number is $309. This is not speculation. This is not my opinion. This is not some chart pattern I drew at 2 in the morning. What I am holding right now is an internal Goldman Sachs Risk Committee memo that was sent to their board of directors just 72 hours ago. And this memo contains an admission that Goldman has been hiding from the public for 18 months. Goldman Sachs is trapped. They are short 4.7 billion ounces of silver, and according to their own internal calculations, they have until the end of this month to begin covering. Not next quarter, not next year, this month. And their models show that when they start buying, the price goes to $309. That is Goldman's number, not mine, theirs. Let me show you exactly what this memo says, because when you see the math, when you see the timeline, when you see what they are planning to do starting next week, you will understand why I am telling you right now, do not sell a single ounce. The memo is dated January 12th, 2026. The header reads Goldman Sachs Group Incorporated, Risk Management Committee Emergency Briefing. Subject, silver derivative exposure, margin call risk, and forced exit scenario analysis. Now, listen to this opening paragraph. It says, on January 10th, 2026, the Risk Management Committee was informed by the Prime Brokerage Division that Goldman's aggregate silver short position has reached critical threshold levels. Current exposure stands at 4.7 billion ounces across futures, options, and over-the-counter swaps. Margin requirements have increased 340% since November. Counterparty risk has been elevated to level 4, which is just one level below maximum. The committee recommends immediate preparation for position reduction, commencing no later than January 22nd, 2026. January 22nd. That is just 10 days from now. Goldman Sachs is about to start buying 4.7 billion ounces of silver. And they have to do it fast, because their counterparties are demanding margin. Their prime brokers are threatening to liquidate. And every single day they wait, the hole just gets deeper. Section 2 of the memo explains why this is all happening right now. The title is Margin Escalation Timeline. The memo states, between October 2025 and January 2026, the silver spot price increased from $34 to $87, representing a 156% appreciation. Goldman's short position moved from profitable to severely underwater. Mark-to-market losses currently stand at $89 billion. Margin calls from prime brokers have totaled $34 billion in the past 90 days. It continues, Goldman has met all margin calls to date using emergency credit facilities. However, available credit is exhausted. The next margin call, estimated at $12 billion, is due January 18th. Goldman cannot meet this call without liquidating other positions or beginning silver covering operations. So here is the situation. Goldman owes $12 billion in margin on January 18th. They do not have it. Their credit lines are maxed out. Their only option is to start buying silver to reduce their position and free up that margin. But when a giant like Goldman starts buying 4.7 billion ounces, what do you think happens to the price? Let's jump to section 4 of the memo. The title is Market Impact Modeling and Price Scenarios. And this is where it gets absolutely insane. The memo states, Goldman's quantitative strategies team modeled 3 scenarios for position reduction. Scenario A, a slow exit over 12 months. The average purchase price would be $156. The total cost, $733 billion. But margin relief would be insufficient. So that's not viable. Scenario B, a medium exit over 4 months. Average purchase price, $241. Total cost, $1.13 trillion. But margin relief would be delayed, making it a high risk. And then there's Scenario C, a fast exit over just 6 weeks. The average purchase price, $309. The total cost is $1.45 trillion. But the margin relief is immediate. This is their recommended scenario. Goldman's own team is telling the board that the only way out is a 6-week sprint that takes the price of silver to $309. They ran the models, they did the math, and $309 is the number. That is not the worst case scenario. That is their recommended plan. The scenario that gives them the best chance of survival. But here is what makes this even worse for Goldman. Section 5 is titled Competitive Covering Risk. The memo states, intelligence indicates that at least 3 other major institutions are preparing similar exit operations. JP Morgan, HSBC, and UBS have all shown signs of position reduction in recent weeks. If multiple institutions attempt to cover simultaneously, available silver supply will be insufficient. The price impact could exceed model projections by 40 to 60%. And what's their recommended action? Begin covering before competitors to secure supply at lower prices. Goldman knows they are not alone. They know JP Morgan is covering. They know HSBC is in crisis. They know UBS is liquidating. And they know that whoever starts buying first gets the cheapest silver. So Goldman has to move, and they have to move fast. Not just to meet margin calls, but to beat the other banks to the available supply. This is a race, and it starts in 10 days. Section 6 of the memo analyzes where the silver is going to come from. The title is Available Supply Assessment. The memo states, global daily silver trading volume averages 9 million ounces. Goldman's required daily purchase volume for a 6-week exit is 112 million ounces. That is a ratio of 12.4 times the daily volume. Then it lists available supply sources. Comex registered inventory, 28 million ounces. LBMA reported holdings, 180 million ounces. ETF holdings available for redemption, approximately 290 million ounces. And the estimated private seller response at over $200 is about 340 million ounces. The total accessible supply is 838 million ounces. Goldman's requirement is 4.7 billion ounces. The shortfall is 3.86 billion ounces. The silver simply does not exist. Goldman needs 4.7 billion ounces. The world has 838 million available at any reasonable price. That is a gap of nearly 4 billion ounces. And remember, Goldman is not the only buyer. JP Morgan needs silver. HSBC needs silver. China needs silver. Everyone is chasing the same 838 million ounces. There are not enough ounces for everyone. But Section 9 of the memo is the one that made me record this video immediately. The title is Retail Holder Behavior Assumptions. Listen to this. The memo says, models assume that retail investors holding physical silver and silver ETFs will begin selling when prices reach the $150 to $180 range. Marketing coordination with brokerage partners will encourage profit-taking at these levels. Projected retail selling, 180 million ounces. The supply is critical to Goldman's exit strategy. Let me translate that for you. Goldman is counting on you to sell. They are planning to have brokers call you. They are planning media stories telling you to take your profits. They are planning to scare you into selling your silver at $150 so they can buy it to cover their shorts. Do not fall for it. Goldman needs your silver. You do not need to sell. Goldman's own memo says the price is going to $309. So why would you ever sell at $150? Why would you sell at $180? Goldman is ready to pay $309. Make them pay $309. The memo is real. The 4.7 billion ounce short position is real. The January 22nd start date is real. And the $309 price target is real. Goldman is trapped. They cannot meet margin. They cannot wait. They cannot hide anymore. In just 10 days, Goldman starts buying. And when they start, the price doesn't stop at $100. It doesn't stop at $150. It doesn't stop at $200. It goes to $309. That's Goldman's number. Goldman's math. Goldman's crisis. Hold your silver. The squeeze starts this month. Goldman Sachs just confirmed it. Thank you for watching. Make sure to subscribe and hit that notification bell so you don't miss any updates on this incredible story.